Good afternoon. I'm Richard Porritt. I'm the editor of the Eastern Daily Press, and I'm delighted to welcome you to today's Lovewell Blake Autumn Statement webinar. Soon I'll hand over to Ed Passmore, who will discuss personal taxation, and then to Mary Schofield, who will focus on corporate taxes. We also have Rob Geary and Chris Egmore, who can jump on and answer questions about VAT and financial planning if we require them. And there will be an opportunity, of course, for questions at the end. If you want to ask our experts anything, then stick your query in the Q&A box at the bottom of the screen, and we'll get to that before we close. So, last week's autumn statement was the most clearly political for many years. Whether you personally came out of it well or not, there is no denying that this statement screams, vote for us. Alongside the jaw-dropping reshuffle the week before, we saw, of course, David Cameron looming out of the political wilderness. I certainly didn't. Jeremy Hunt's statement is Rishi Sunak's Hail Mary. It's a final punt aimed at clawing back Tory centre-ground voters who are flirting with Sir Keir Starmer's Labour. Or is it? Well, probably not, because I would expect more rabbits to be pulled from more hats in the spring, and I also expect an election soon after that. Oh, joy. I don't think the Tories are going to want to wait until this time next year to go to the polls. Two eye-catching fiscal statements back-to-back and away to the ballot box in May. That would be my advice to the Prime Minister anyway. So are the Tories panicking? Yes, I think they are a little bit. Well, quite a lot, in fact. Only a few weeks ago, we in the media were being briefed that there would definitely not be tax cuts. No way, came the reply from both number 10 and number 11. But then a week is a long time in politics. Now, of course, Labour argue, and the OBR agree, the tax burden remains at a historic high, but Mr Hunt's move on national insurance certainly caught the headlines, and the voters will have noticed. But is it enough to turn the dial? Well, a few polls showed a slight bump for Mr Sunak, but more saw Labour increase their lead, and it is already a significant lead. This government feels like it's coming to the end of the road. After being in power for more than a decade, they've run out of real talent at the top, hence the return of Mr Cameron from his shed to the Lords. Now, the parties, I predict, will get closer in the run-up to the general election, but the Tories need a miracle, and they need Labour to catastrophically drop the ball. Now, it's happened before. Those of us with long enough memories will recall 1992, but this would have to be a truly seismic boo-boo. So what about Labour? Well, they appear to have just about weathered the wobbles over the Middle East, although I personally don't think that would hugely worry the centrist voter that they need to get a majority. So Keir's not yet had the personal cut-through of a Tony Blair, say, but the public do appear to view him as statesman-like and trustworthy. He does appear to be a safe pair of hands in the wake of years of upheaval. And that's a touch unfair on Mr Sunak and Mr Hunt. They have steadied the ship post Liz Truss's calamity, but now all they can do is punt it long and hope for the best. So let's get to the real reason you came. Let me pass you over to Ed Passmore.
Thank you very much, Richard. Right, I'll just share my screen now and bring up the presentation. So hopefully that's all on screen now. And yes, by very way of a brief introduction, I'm Ed Passmore and I'm a tax partner here at Lovewell Blake. And as part of my presentation, I'm going to be focusing on the more personal tax elements and announcements that we had in the recent autumn statement. So as a useful...
Ed, sorry, we can't see your screen. We can't see your...
Oh, has it not come up?
No.
Okay, why is that? Try that again.
Here's the proof that it's live. You see, it's the risk attached to it makes it much more fun, doesn't it?
Well, hopefully that's now come up. Tracy, Richard.
You just need to do your slideshow.
Yep.
Ed.
Brilliant. Apologies.
Thank you.
Brilliant. So apologies for that. So yeah, as I said, I'm Ed Passmore, tax partner here at Lovewell Blake, not a technology partner. Right, so moving on, I think Richard gave us a very useful introduction there into the budget. into the statement, sorry, and despite being mooted as one that wasn't one of tax cuts, actually we saw a number of tax cuts, or certainly perceived tax cuts. And coupled with that, there was the theme that the government are looking to get people back into work, or more people working. So from an income tax perspective, there were no real changes made to either the rates or allowances. And as we can see here, the personal allowance, which is the amount subject to income tax at 0%, remained at £12,570. And the higher rate threshold remained at £50,270. So above that is the rate you begin paying 40% tax. And these have remained constant despite inflationary pressures leading to wage increases. And ultimately what this has done, or will mean, is there's fiscal drag in play, meaning that more people are either pulled into paying tax or paying tax at a higher rate. And it's through this that you may have seen people refer to stealth tax rises. The additional rate, which is 45%, again, that has remained constant at £125,140. And both of these, or all of these rates, are to remain constant until 27-28. So quite a long time yet, and possibly quite a lot of inflation to go through before we see any movement in those. One final point on that is the personal allowance abatement level. That once your income exceeds £100,000, for every £2 of income over that level, you lose your personal allowance at £1. And that level has remained constant. So once you get income in excess of £125,140, you get no personal allowance at all, so no 0% tax rate. So national insurance, despite, we didn't see any changes made to income tax, but we did, however, see a number of changes being made to the national insurance regime. And there's potentially a couple of reasons for this. While income tax is quite a general tax, it covers all sorts of income. National insurance is focused specifically on income that is received from work. So that then enables the government to present this as an incentive and a reward to workers, whilst actually it's cheaper for the Treasury than a cut in income tax, because it applies to a smaller pool of earnings. In previous statements and budgets, the government have received some criticism for focusing many of their policies at the older generation, those who are traditionally more likely to vote. But in this case, national insurance is not payable on private pension income, nor is it payable by anybody once they have reached the state pension age. So in fact, most retirees will not benefit from these cuts in national insurance at all. So in terms of the rates, when we move on to these, we'll start with self-employment. And there have been two changes here. So Class 2 and Class 4 were both types of national insurance that were paid by the self-employed. For Class 2, this was previously, or is currently, set at £3.45 per week, and this has now been abolished. So this gives a saving of approximately £179 per year. There will, however, continue to be access to contributory benefits such as the state pension, and this will be, you'll be treated as making contributions if you have profits in excess of £12,570. And for those with the low earnings, they are still able to make voluntary contributions to obtain state pension entitlement, and the rates for those are being frozen at the current level of £3.45 per week. The other major change in the self-employed spectrum was the cut to the Class 4 national insurance rate. And this has been cut from 9 to 8% on profits between 12,500 and just over 50,000. And both the changes to Class 2 and Class 4 are to be effective at the start of the new tax year on the 6th of April 2024. Then for the employed, there has been another cut here. So Class 1 national insurance has been reduced from 12% to 10%. And again, that's in the same bracket as for Class 4, up to £50,270. However, earnings, and the same is true for Class 4 here, any earnings or profits in excess of £50,270, the rate there remains the same at 2%. People in employment, though, will see this benefit sooner than those in self-employment, because this change to Class 1 National Insurance is effective as of the 6th of January 2024. So, looking at self-assessment, there has been a minor change here, which is part of HMRC's drive to simplify the self-assessment process, and I think give themselves less tax returns to look at. So for individuals who are earning over £150,000 per year via PAYE, they are going to be removed from self-assessment and no longer need to file a tax return. And this will be starting from the 24-25 tax year. It's a relatively significant change and will mean that up to 338,000 taxpayers are no longer required to submit a tax return. I would caveat here, though, that if people in that position do have other earnings, dividends, income, saving, or rental properties, they are still required to submit a tax return, which would, of course, still include the income they've received via employment and their subsequent PAYE. So moving on to sole traders, this is a fairly significant change. So currently, in calculating the profits or losses that a sole trader business makes, there are certain rules around when you have to use what is known as the accruals basis. And this is a more complicated method of calculating profits and losses, but HMRC have flipped this whole system on its head now and have confirmed that the cash basis will become the default for sole traders. And under this basis, profits are calculated when income is received and payments are made. This is a pretty significant change and can result, or may well result, in some very different profit and loss figures for a lot of businesses. Under the cash basis, historically, there were various restrictions on this, which is why certain businesses decided, although being simpler to implement and work through, they were not going to use it. And one of those was around interest deductions. Previously, there was a limit of £500, which could be deducted each year in respect of interest costs. Whereas now that has been removed. And I think that's in line really with the increasing rates of interest that we're seeing throughout the economy, and people thinking they weren't really getting the full reflection of their costs without that. So now they have removed that restriction, and any limit of interest payments can be deducted in calculating profits. And further to that, when looking at losses, previously losses were restricted in what you were able to do with them, but now they have removed all restrictions, and any losses generated under the cash basis can be used sideways against general income, or also carried back against other income from earlier years. There is, however, the option to elect to use the accruals basis if businesses so wish. And say that election there, if one of the reasons you may still wish to do that are shown here. And for some types of businesses, using the cash basis is not really appropriate, because accruals basis accounting generally gives you a truer measure of the profitability and the position of a business in any given period. And most importantly, when applying for finance, banks often require the accounts to be shown in a accruals basis format. And then for other businesses that are seasonal or as fluctuating in their sort of turnover and levels, or those that have higher levels of stock and more generally larger businesses, the accruals basis is still likely to be a better method of calculating your profits. But as I said, this is a wider package of simplification methods that HMRC are introducing, and they estimate that this could affect up to 4 million sole traders. And again, this will be a change that comes in from the 6th of April, 2024. So pensions, these are much talked about in previous budgets and statements, and more of an administrative change, the first slide here. And this is one where the government are looking to consolidate small pension pots. And the reason for this is they estimate that there are £26.6 billion in lost pensions. So I suppose this really applies to individuals who have changed jobs or have had a number of different jobs and therefore have been entitled to different employer pensions. What they're looking to do is try and consolidate that to make it easier for individuals to keep track of what's in their pension and how that's growing. So individuals going forward will have the option to designate a primary pension scheme for their contributions. And on taking up new employment, employees are going to be given the legal right to require that new employer to pay contributions into their existing pension pots. So contributions, the level of pension contribution you can make each year, there is no change for that. And the maximum amount that can be contributed per annum, it remains at £60,000. However, this can be tapered down to a minimum of £10,000, with tapering starting for those with income exceeding £260,000. State pensions, on this one we heard that there is going to be an increase in April of 8.5%, so a fairly significant increase there. But as we touched on at the beginning, with the personal allowance and higher rate thresholds staying at the same level, will this push more people into be either having to submit tax returns or the higher rate of tax? So as a final point on pensions, the lifetime allowance gets quite a lot of press at the moment. And previously, the aim of the lifetime allowance was to limit the amount of tax-free pension contributions an individual could benefit from. And we'd seen this lifetime limit was up at £1.8 million a few years ago, and subsequently reduced down to £1,073,000. But now, in the budget previous, they confirmed that this lifetime allowance was going to be abolished. What we've heard is that this abolition is going to go ahead as planned from the 6th of April 2024. The difference here is previously, if you had exceeded your lifetime allowance and then decided to take this as a take this as a lump sum, there would have been a 55% tax charge on this, or a 25% charge if the pension was to be drawn over the lifetime. In terms of the tax-free lump sum, this is going to remain as being based on the current lifetime allowance. Therefore, this means you should be able to receive up to £268,000 of your pension pot tax-free. Any excess over that which is drawn down will then be subject to income tax at the individual's marginal rate of tax rather than potentially 55%. So from a tax relief perspective, the EIS schemes, so enterprise investment schemes, and venture capital trusts are some tax-favored investment schemes, and these have previously had a sort of lifetime on them, and these are really geared at trying to encourage investment in startup businesses, small companies, and that is done by providing generous tax incentives from both an income tax and capital gains tax perspective. These look like they were coming to an end, and the government have now decided that they are going to legislate and extend the lifetime of these schemes for at least 10 years, so taking these through to 2035. If the government is committed, though, to encouraging investment in these types of business, you do have to wonder whether these schemes should just be made permanent, and then people could stop look at having to legislate or discuss how these can be extended. We now move on to ATED, or annual tax enveloped dwellings. And these are tax charges, or it's a scheme where UK residential property is owned within a company. So in this case, there is an annual charge of the property, where the property is owned, there is an annual charge which is payable by the end of April, along with a return that needs to be filed. And these charges are based on the value of the property, and these are going to be increased in line with inflation by 6.7% from April 2024. On the smallest value property, so that it only comes in and applies where you have a property worth over £500,000. And for the bracket between £500,000 and £1 million, the annual charge is £4,400. But if you have a property which is worth over £20 million, the annual charge is £287,500. For all you landlords out there who are owning properties through companies or looking to do that, given the beneficial interest deduction position, there are exemptions and reliefs that continue to exist. And one of the reliefs is where a property is let to an unconnected third party on a commercial basis. This scheme does not apply. So don't panic if you've suddenly purchased a property in a company and think you're going to have to pay this extra level of tax. Just a small comment here on the national living wage. This has been increased by 9.7% and has gone up to £11.44 per hour. And this is thought to be worth approximately £1,800 a year for any full-time worker. It was also a more wide-ranging impact than that because they have reduced the age threshold to 21 years old, meaning that more people should benefit from the rise in this wage. So, capital gains tax. This is an area where we constantly get a lot of questions as tax advisors, and one where it seems to be rumoured that there are intentions to align the capital gains tax rates with income tax. However, nothing in the statement in that vein at all, and no real changes to capital gains tax at all. Higher rate taxpayers pay capital gains at 20% on investments such as shares or 28% on residential property. The only real change going forwards is the capital gains tax exempt amount is going to drop further to £3,000 as of the next tax year. So we've seen a fairly significant change in that over the last couple of years, with it being at £12,300 last year, currently at £6,000 and then falling to £3,000 next year. A bit of reduction there, so not a tax cut in this perspective. Business asset disposal relief, which still remains a key relief for people looking to sell business assets. This remains an available relief, with the capital gains tax rate being a beneficial rate at 10% up to the lifetime limit of £1 million of gains, and then there's no changes have been made here. So final bit of advice there is, given the annual exempt amount is dropping to £3,000, appreciate it's only a small change, but if you have disposal that you're looking to conclude on, if it's possible to get these done before the 5th of April 2024, there will at least be a small benefit from a capital gains tax perspective. And inheritance tax. So, in leading up to this statement, there seem to be rumours that inheritance tax was going to be scrapped. However, no mention at all in the statement about this. And I think, as Richard alluded to in his introduction there, this is not, we're not yet at election stage. So one wonders whether announcements around inheritance tax could be saved for that pre-election budget, whereby they think it may have a bigger impact and swinging voters back to the Conservatives. But still speculation at the moment, but no changes on the inheritance tax landscape. So the rate of inheritance tax remains at 40%, or as we see here, 36%, where 10% of the estate or more is left to charity. And much like with all our other rates and allowances, they've remained constant here until 5th of April 2028. So as property prices move, I appreciate we may not be quite in the sort of level of increases that we've seen over the last few years, but that remains at £325,000, and the residence nil rate band remains at £175,000. So taking both of those together, and with increasing values and inflation, are more people going to be pushed into a position where they have an inheritance tax liability becoming due? And really, that concludes the update, I think, on the personal taxes position. We're now going to hand over to Mary Schofield, who will take us through some of the more businessy corporate taxes.
Thank you very much, Ed. Just bear with me one moment whilst I put on the screen my slides. Perhaps Ed, you can tell me when you can see them.
It's come up for me now, Mary. Yep.
Excellent. Well, I'll try, make sure I can move on to the... Oh, I'm not technology partner either. Oh yeah, there we go. Fabulous. Thank you very much, Ed. Well, good afternoon, everybody. It makes a bit of a change to be doing one of these budget presentations after lunchtime, so I'm sure I'll refer to the morning at some point, but I'll try my very best not to do so. So if you listen to commentary around the autumn statement, a lot of the commentary suggested that there weren't many business tax changes announced, but I think the ones that were pretty fundamental. And research and development tax relief is probably one of the biggest changes that was announced last week by the Chancellor. So for any corporate out there claiming R&D tax relief, we have got a fairly short window to get our minds around the forthcoming changes to legislation and what that might mean for our overall tax rate and cash flow. So if we think back to the spring statement, it was announced then that it was likely that the UK government were considering merging the two R&D schemes that are currently legislated for. So, and if you are anyway interested in R&D, you will know that there are two schemes. There's the RDEC scheme, which is typically used by larger companies, sort of big pharmaceutical companies, and then there's the SME scheme, which has always carried with it much more preferential tax rates and a tax credit system. So the SME scheme. So going forward, so for accounting periods beginning on or after the 1st of April 24, there's going to be a merger of these two schemes. And yeah, you've guessed it, we're going to be adopting the RDEC scheme, which is slightly less favourable to the SME scheme. Now, I am going to move on in a bit. You might recall there is a special scheme for R&D intensive companies, but for now, I just wanted to focus on the merger of the two schemes and the RDEC scheme. So the headline rate of the RDEC scheme is 20%, and I'll explain a little bit more about how that's going to work. But there are also some of the legislative changes coming with the new merged R&D scheme, and the first thing is around subcontracted R&D. Now, this has always been a thorn in the side for the UK government in terms of how to administer where you've got subcontracted R&D, because you might have one corporate who thinks that the R&D is theirs, and they say to corporate number two, can you, we're trying to develop XYZ, what we really need you to do is to do Z because we don't have the capability. And we run the risk of having two different corporates claiming research and development tax relief on basically the same expenditure. So I think we're likely to see going forward much more prescriptive rules around which entity is going to be entitled to claim that R&D. And I think that there's been some very notable cases that have gone through to the tribunal on whether a particular subcontractor was entitled to claim the relief. So I think contractual terms around which organisation is going to claim the relief will be reasonably pivotal. You may also recall that this rule around R&D being conducted offshore is now going to be coming in with effect from 24. So there was a 1-year grace period to, I guess, allow the legislation get in place and let businesses get in order. But if you are conducting your R&D overseas, you're subcontracting it to an overseas connected company or whatever the facts may be, I strongly suggest you consider whether or not you're going to be able to claim tax relief on that going forward. There are some exemptions, but they are very few and far between. And then rules around subsidised expenditure. So for SMEs, this has always been reasonably restrictive because a lot of smaller businesses, startups, tech businesses, they are in receipt of grants and quite often notifiable state aid in terms of, say, for example, Innovate grants, which has actually precluded them from claiming under the SME scheme anyways. So there's going to be some rules around which could be good for SMEs in terms of continuing to be able to claim the RDEC on expenditure which has been subsidised by a third party. So we'll have to wait and see how those rules are going to be legislated for. So just thinking about the RDEC scheme and how that's going to work. So we say that the headline rate is 20%, but it doesn't quite work how the historical SME scheme has worked. So you'll hear bandied around about the RDEC scheme, what's referred to as an above-the-line tax credit. And what that means is that you take your qualifying expenditure, which is shown in this example of £100,000. Now, the RDEC rate is set currently at 20%. You may recall it took a bit of a hike northwards from 13%. About 12 months ago. So you take your qualifying expenditure, you take the RDEC rate, which in this example would give you 20,000. You then tax that 20,000 in your tax computation, which I know will probably seem quite odd to anyone who's historically made a claim under the SME scheme. And then essentially you're entitled to a tax credit also of the 20% of 100,000. I know this sort of suggestion that we're trying to simplify tax might seem rather lost on you at this point, but what it means is, in simple terms, that even though the RDEC rate is 20%, you actually only end up as a company with a tax credit of 15%. So in this example, 15,000. And I think just at this point, it's worth contrasting what that might mean in terms of cash flow for your average SME, because obviously under the old rules, you would have been able to take your 100,000, uprated it by 130%, so pretty much the rules that were in 12 months ago. And then of that additional 130,000 at 19%, the effective tax saving was just shy of 25,000. So you can see quite quickly that there's quite a big difference between what an SME might get under the RDEC system to what an SME might get under the old SME scheme. So as I sort of briefly mentioned, so all is not lost, because of course, in spite of the fact that we're talking about there being a merged system for research and development claims, the announcement back in the spring statement was about a new set of rules which were for what's referred to as R&D intensive companies. Now, these rules are currently in play, albeit because they came in on the 1st of April 23, we're unlikely to have had any accounting period ends yet, which sort of deal with the issues around this. But effectively, the old SME rules still apply to an R&D intensive company. And an R&D intensive company, as was introduced in the spring statement, was one which has qualifying R&D, which constitutes roughly 40% of its total expenditure. Now, in the autumn statement last week, the Chancellor announced that that this threshold of the 40%, which no doubt was perceived to be relatively high, has been reduced to 30%. So if 30% of your qualifying expenditure is qualifying R&D, then you arguably be able to lock into these rules. Now, just have to remind ourselves that, of course, the 130% numerator was dropped to 86%. So, you know, we had toppled slightly from the maximum tax relief. But I think, you know, for any businesses that are doing a significant amount of R&D who want to lock into this sort of slightly reduced SME scheme, which is going to sort of continue for the foreseeable future, you obviously would be incredibly disappointed to realise at the end of the day that your qualifying R&D spend was, say, 38% or 28%, you know, depending on the year. So I think there's definitely a little bit of planning to be considered for those businesses that want to qualify under this scheme. Naturally, there will be a complex set of rules regarding groups, such that you can't manipulate the R&D company to make sure that it's got quite a chunky percentage, whereas overall costs in the group, it will come nowhere near the 30%. And to cater for sort of fluctuating expenditure levels, there's going to be there'll be a one year grace period. So say you dip down in terms of qualifying expend because maybe a project tails off and you haven't geared up to the next project, there will be that 1 year grace period, which is likely to be particularly helpful for companies. So I just wanted to illustrate, you look at this slide, which I have to claim I didn't do myself. It was done by my excellent colleague, Sam. But you look at this slide and you say to yourself, has the R&D system been simplified? Well, given the sort of varying outcomes, there is still a lot of complexity to R&D and a lot of complexity to what the repayable credit might mean to you and how much it might be and how you might lock into it. So if I it's sort of reasonably self-explanatory, but if I could maybe just talk you through it a little bit. So if we go back to our example of having £100,000 worth of qualifying expenditure, you can sort of see under the sort of top half of the slide, you can see for a profit-making company, as we talked about previously, you're looking at overall a tax credit, so a reduction on your corporation tax bill of about 15%, 15p in the pound. If you're a loss-making business under the RDEC scheme as an SME or a large company, you are still able to claim a repayable tax credit as long as you've settled all your other taxes, and that will be slightly higher than the 15%. It will be just over 16p in the pound. But if you contrast this with the existing SME scheme, which is going to continue into the future for R&D intensive companies, you can see that for the £100,000 qualifying expenditure, you're getting roughly 27% back in terms of a credit. So you can see how important the ongoing smaller more compact SME scheme, how valuable it is and how key it will be for companies doing significant R&D to meet the threshold. And you know, I'm just going over old ground now, but the bit in grey shaded out that way because those are the heady days of the 130% now no longer with us. But back then, the tax credit was worth a third of qualifying spend. So, yeah, so there's another little piece of proposed legislation going to be introduced by the Chancellor with respect to when a company completes its corporation tax return and fills in its CT 600, it is possible. So ordinarily, you know, if you've got a repayment due from HMRC, you fill in the company's own bank details, and that cash would come back to the company as a refund when processed by HMRC. Now, we see it quite a bit here that sometimes companies will instruct a third party to do their R&D claim for them, and that third party will invariably insist that the bank details of the third party are included rather than that of the company, such that I guess, you know, in simple terms, to ensure that they're going to get paid for doing their R&D work, that money will go to them. Now, I think as this measure is introduced, because, you know, HMRC don't like the feel of that. They don't like the feel of, I guess, an organisation having significant amount of control over the repayable tax credit. And I think that they just think that by putting in this rule whereby the money that is due to the company has to go back to the company, it creates a little bit less opportunity in the market for maybe enthusiastic claims. So, and it's quite interesting, actually, that the government estimate that for 21-22, the tax fraud around R&D, so basically non-compliance, was about 1.13 billion. I mean, I think that, you know, that is an absolutely huge number. Whether or not that is the full extent, you know, because quite often when HMRC apply pressure to taxpayers and open inquiry into their tax affairs, you know, for all sorts of reasons, taxpayers don't have the palate to continue with a tax investigation. It may be that the fees of dealing with it are expensive. You know, they don't like the scrutiny. They can't sleep at night. They're actually trying to run their business and do other things. So a lot of R&D claims are actually withdrawn, and sometimes the revenue do refer to these as non-compliance or fraud, which I think isn't strictly correct. And just on, there's a few final points here. There are also things that HMRC have introduced in recent times, and no doubt some of you taxpayers sitting out there listening to this won't yet have filed your R&D claims. But you know, the HMRC have got quite a lot more sort of enthusiastic in how they're trying to police R&D claims. So, you know, you can't just attach a claim form to your CT 600 now. You can't just attach a little narrative. You've got to fill in a digital form. You've got to provide very comprehensive breakdown of costs. You've got to name the person at the company who's standing by the claim, name the agent, so your accountant or third party who's prepared it. And just a gentle reminder here about if you've not made an R&D claim and your company wants to make an R&D claim, you have to notify HMRC in advance if you're going to do it, if you've not been if you don't really have a claim history with HMRC. And that notification period falls fairly swiftly after the end of the accounting period, within 6 months. So, you know, busy entrepreneurial people doing a lot of things to promote their business and get stuck into their R&D, you know, 6 months soon passes. Good. So moving on from the R&D tax relief onto capital allowances. So there weren't wholesale changes to the capital allowances regime, but this is just a little reminder around, you'll recall back in March 21 that the super deduction was introduced, which gave an uprated tax deduction for qualifying spend, that what we refer to as accountants as main rate expenditure, but that is your average sort of plant and machinery used in your business. So super deduction was in from March 21 to March 23 with the 30% hike. Then obviously, because of the increased corporation tax rate, that 30% was withdrawn, and the temporary full expensing policy was introduced. Now, full expensing policy is all about if you incur qualifying expenditure, that you can take full tax relief for it in the year that you incur it. Now, because full expensing is what's referred to as a first year allowance, you have to claim it in the year in which it is incurred. So it's important to be very organised as a taxpayer and not miss the filing deadlines for your corporation tax return, because you could find your expenditure slipping out of the full expensing policy and back into the 18% pool should you have exhausted your annual investment allowance. So, and just a reminder about full expensing, it is only available to corporates. It is only available on newly purchased, you know, new assets, so you can't apply to second-hand assets. And there are some fairly restrictive rules around leasing. So other than some very minor let-outs for leasing, which is where you're leasing a building which incorporates plant and machinery, or you're leasing a service, so such as a man in a crane, so you're leasing the pair, you can't claim full expensing on leased assets. I think it's important at this point. This is quite a sort of a headline tax giveaway, as announced in the autumn statement. But we have to remember, for your average SME, that the backdrop to this full expensing policy is the significant hike in the rate of corporation tax from 19 to 25%. So that's full expensing. Okay, it gives excellent certainty to businesses, and probably bigger businesses, but it's off the backdrop of a 6% corporation tax hike. And as I remember that full expensing is not saying it doesn't facilitate more tax relief, because if you're saving tax up front, then you might spend more money on capex. But of course, full expensing is a timing difference. You would eventually have got tax relief for that asset had it sat in the pool. And I guess the other question is does this make the tax capital allowances system simpler? Well, it's simple to introduce, because you're essentially just saying that what was once upon a time a pooled item, 18% per annum, it's now 100% in the year of acquisition. So it's not exactly, there's still quite a lot of complexity in the capital allowances legislation. And you may recall that there's for special rate expenditure, the 50% rule still applies. So if you buy an asset which would not qualify for the main pool, so you can claim 50% up front against your profits, and the other 50% will still go into the special rate pool. But that's not to forget the annual investment allowance. So because of course the annual investment allowance doesn't just extend to companies, it also extends to unincorporated businesses. So is still in my view, it's still the tax relief for capex that we should be thinking about first, and making sure we're using it. And the reason I say that is because when you acquire assets and claim the annual investment allowance on them, they're pooled, so they sit in the pool. When you claim full expensing on an asset, then you essentially have to track that asset, because it isn't pooled. And when that asset is sold, then you get a clawback on the proceeds received. So there's quite a bit more administrative paperwork around full expensing, which, it's not the end of the world, but given that for AIA, the asset is pooled, you don't have to concern yourself with whether or not it's brand new or secondhand, and you can claim your annual investment allowance can cover special rate expenditure. So it is still super flexible, and I think we're probably all pretty happy it still sits at £1 million. So there is a consultation around simplifying capital allowances. We have no insight at the current time as to where that might go, but I wonder whether full expensing in the fullness of time might be extended to unincorporated businesses. There's certainly going to be something around, because it was announced last week, around whether full expensing should be extended to companies that lease assets. So we'll just have to wait and see. I think the one area that was pretty notable, anyone who's studied capital allowances legislation over the last few years, I appreciate that won't be too many of us, but you'll be very aware that green technologies have figured quite highly. So the UK government have made a big thing around electric cars, electric charge points, and assets like that. Now those rules, the rules on electric cars and electric charge points, etc., are still in play, but there was very little new announced on that front last week. So enterprise management incentives. Now these are, this is a tax advantage share scheme, which is used by a lot of growing businesses in order to incentivize and keep employees keen to work and grow the business. So there's a few administrative changes which I think will prove beneficial. So like a lot of tax advantage things, there's a lot of tax administration that goes with them, which can be pretty costly for the company and can be on a fairly tight window. So when under a tax advantage DMI scheme, options are awarded to an employee, then there is a 92-day window within which those options need to be notified to HMRC. And if you miss that window, then the shares or options, they're no longer tax advantaged. So, I mean, quite frankly, if you miss the deadline, it's calamitous. So that 92-day deadline has now been brought in line with the annual reporting deadline for employment-related securities. So you'll have until the 6th of July following the tax year in order to report those to HMRC. And there was a few other sort of simplification amendments which were introduced, which there's always been a requirement historically in the sort of option agreement that a company would have with its employee to detail the restrictions attaching to shares. That's going to be removed. And there will continue to be a strict working time regulation for EMI option holders, such that you have to work full time for the company or 75% of your working time. That condition still needs to be met, but there was always quite a bit of faff around getting an employee to sign a declaration and attach it to the paperwork, whereas that has been phased out. And the government actually does continue to consult on share schemes, sort of making them fit for purpose. So amendments were made to the CESOP scheme, because of course EMI schemes, whilst they are fabulous and tax advantaged, there's an awful lot of industries to which they are not relevant because they're excluded by the UK government, for example, the care sector and law firms. So we just watch this space to see where share schemes are going. And another announcement last week was tax relief for so what the UK government refer to as a sort of creative industry. So for expenditure incurred by businesses on films and TVs and video games, so the production of short films and things like that, they're going to be another above the line tax credit. So it's going to operate in a fairly similar way to the RDEC scheme, but with fairly generous rates. And I think the publicity around the film industry in this country has been quite positive, and I think the UK government is still keen to make the most of that. And there's a sort of an interesting there's an interesting little change to the legislation to do with off-payroll working. So off-payroll working, you may be aware, there is a requirement for businesses that engage individuals to work, and they're operating via personal service company. So if you're either a public sector engager or you're a medium or large engager, then you are required to assess whether or not, in the absence of that individual's personal service company, would they be an employee? So the rather sort of straightforward term that the HMRC uses is this: where an individual is working like an employee, they should pay tax like an employee. It's a simple statement, but this area of legislation is absolutely fraught with difficulties, because actually just trying to establish whether someone is an employee or a self-employed person is very, very tricky. But there's this piece of legislation that has just been introduced states that where so the engager, so maybe a public sector entity has engaged someone, there's been a problem, HMRC has found that they should have deducted pay as you earn from that individual, then now the rules are in play which would suggest that if the individual's personal service company has paid pay as you earn, that can be credited against the pay as you earn due from the deemed employer. And I think it's of note that these regulations will be relevant for payments made as far back as 2017, which was when the public sector rules were introduced. So I think it's probably to address a very specific issue to do with public sector deemed payments being coming out of the woodwork now. And just a quick one on the construction industry scheme. So, not a huge change, but obviously, when the construction industry scheme is a massive cash flow disadvantage for subcontractors. So to have that gross payment status, whereby when you receive payment from the main contractor for the work you've done on the construction site, to be paid gross is pretty important for cash flow purposes. Naturally and expectedly, HMRC expect that if you're going to be paid gross as a subcontractor, you have to have your tax affairs in order. And the latest sort of step in HMRC in trying to ensure that a subcontractor's tax affairs are in order is extending the rules to VAT. So in any shape or form, your VAT is not reasonably squeaky, then HMRC might withdraw that gross payment status and you'll be back to 20% deduction at source. Lastly, but by no means least, VAT. So as you all know, I do not claim to be a VAT expert, and all of our sort of fabulous clients out there will all know my colleague Rob Geary, who looks after our VAT affairs here. But I suppose of note is that obviously with no change to the VAT thresholds, so of course more and more businesses are being pulled within the registration limits, which is a fairly common facet of the tax system, given the freezing of most limits. This was just a little nuance of the reforms to the energy-saving materials VAT relief. So the spectrum of it has been broadened slightly to include certain technologies. So if that's obviously relevant to you, then Rob will have more details. So that just about brings me to a close. Thank you very much. Maybe hand you back to Richard.
Brilliant. Thank you very much, Mary and Ed. It's all really insightful stuff and lots for all of us to get our heads around, I think. Now we're running perilously close to the end of our session, but I thought we could just maybe squeeze a question in each that's come in, if that's all right. Ed, let me go to you first. This is a question about private pensions. So if I create a scheme with, say, Scottish Widow, for example, that's more beneficial than a standard auto-enrolment, will my employer be required to pay into that opposed to the standard going forward?
I suppose the short answer really is yes, but it will be at the request of the employee. So the employer may well have a scheme that they have in place already, but on joining that firm, you're going to receive that legal right to ask your employer to pay into the Scottish Widows pension that you have if you think that's more beneficial. So yes.
Okay, well, that's a good bit of insight. Thank you very much. Mary, let's just try and get a quick one in. And there's a lot of chat around R&D. So I am a profit-making company undertaking some R&D. We've made claims in the past. Will the effective rate I receive reduce as a result of these latest announcements?
I mean, I'd say almost certainly. Just reverting back to this thing to do with R&D intensive companies, this threshold of 30%, I mean, it's going to change the way businesses organise themselves, isn't it? Is that if you're, and that's maybe the desired effect, but if you've got 50 grand in your pot and you're going to spend it on marketing or R&D, I mean, but unquestionably, yeah, there's a lot more pressure on the R&D tax relief and rates are going down.
Yeah. Okay. All right. That's fantastic. I tell you what, we'll just squeeze one more in because I think this is one for you, Ed. do you think that directors, shareholders should now start switching from dividend income to salaries in order to take advantage of the national insurance saving?
Interesting question. I think one that is, yeah, we're seeing more and more of. We were seeing that actually even before the national insurance cuts. And the main difference there, I suppose, is the corporation tax rate has increased to 25%. And if you pay a salary, that's deductible in calculating the company's taxable profits, as is the employer's national insurance, whereas dividends are taken out of post-tax profits from the company. So all those bits and pieces factored in, despite there being a cut in national insurance, dividend income is still not subject to national insurance and is also subject to income tax at a lower rate. So from an individual's perspective, it's probably likely that dividends are still a cheaper route from taxation. But if you are a shareholder, director, sort of owner-managed business, and you have control over the company and what you're taking out of it, when you factor in that increased corporation tax rate, it is now a much closer picture, and one that, you know, we would certainly recommend you run. We can run numbers through, and then you can see that that difference has definitely decreased.
Yeah. Okay. Wonderful. Well, it's past, ladies and gentlemen. I'd just like to say that a copy of the slides is going to be sent out, I think, afterwards, so you'll all get to see those. And thank you very much for joining us. It's going to be a fascinating year or so ahead in British politics, and what happens in number 11 will certainly play into that. Thank you very much for joining us at Lovewell Blake's Autumn Statement webinar.